Welcome to Talk Tickers. Today, we're diving into a real head-scratcher with Associated Banc-Corp. Their latest earnings report. Well, on the surface, it looked like a home run, a solid beat. But then, the stock fell. So we're going to break down that disconnect, the great numbers versus the market's big shrug.
And yeah, that's really the big question here, isn't it? Associated Banc-Corp, ticker ASB, comes out with record numbers. They're beating what all the analysts expected, and the stock sells off. So what gives? Let's dig into what the market was seeing that wasn't necessarily in those headline numbers.
But first, you gotta give credit where credit is due. The numbers themselves, the headlines, they looked fantastic. Seriously, by just about every metric, this was an incredibly strong quarter for the bank.
Okay, let's start with the big one, earnings per share. It came in at a solid 80 cents. Now the analysts on Wall Street, they were only expecting 72 cents. That's an 11% beat, which, in the banking world, is a pretty significant surprise to the upside.
And it wasn't just on the earnings front. Revenue also came in really strong at $389 million for the quarter. Again, this was another clear beat, clearing Wall Street's consensus by almost $7 million. So far, everything looks straight.
And here we go. This is a huge one for any bank investor, net interest income, or NII. ASB posted a record-setting $310 million. You have to understand, this is the core engine of a bank's profitability, and it was just firing on all cylinders, up a whopping 15% from last year.
So if you pull back and look at the whole dashboard, all the underlying health metrics were solid too. Their net interest margin was expanding, their efficiency ratio was around 55%, which shows they're keeping a tight lid on costs. And really crucially, their CET1 capital ratio, think of that as the bank's financial safety cushion, it improved to almost 10.5%. Well above the required levels. Everything here just screams healthy, well-run bank.
Now, when you've got numbers like that, you'd expect management to come out swinging with a really bullish story, and they absolutely did. They didn't just frame 2025 as a good year, they called it a pivotal year, one that has set them up for a whole new level of success.
And the CEO, Andy Harmoning, he was super direct about it. He said, and I'm quoting here, 2025 was a pivotal year, and that the bank is entering 2026 with stronger profitability. The message they're trying to send is crystal clear. Hey, this isn't some one-time fluke. This is the new normal for us.
And they backed up that talk with a pretty clear four-part plan. First, they're seeing amazing organic growth. Their commercial loan pipeline is up a massive 43%. Second, they're doing this smart balance sheet remix, swapping out lower profit mortgages for more lucrative commercial loans. Plus, they're expanding through an acquisition and pouring money into high-growth cities. This is their bull case, all laid out.
Then they put some hard numbers behind all that confidence. This is their guidance for 2026. They're telling investors to expect solid growth in both loans and deposits, and really impressive growth in that key net interest income metric, all while keeping expenses in check. But, and this is a huge but, there's a catch buried in the fine print. That entire beautiful forecast, it's all based on the assumption that the Federal Reserve is going to cut interest rates twice in 2026. If that doesn't happen, well, this whole forecast could be in trouble.
And that right there brings us to the market's reaction. Because despite the record quarter, despite the confident story from management, investors basically gave a collective shrug and then started hitting the sell button. So why wasn't Wall Street buying what ASB was selling?
And you can see that disconnect right here on this chart, plain as day. Right after the earnings call, the stock slipped, but then the next day, the selling really picked up, with the stock closing down almost 4% on pretty high volume. The market was sending a very clear, very loud signal of disapproval.
So this slide really sums it all up. You've got two completely different stories being told at the same time. On the left, management saying, look at our record profits, look at our momentum. But on the right, the market is asking, yeah, but is this as good as it gets? Is this peak NII? Management points to their clear growth plan, but the market sees that it all hinges on those Fed rate cuts, which are far from a sure thing. Management is pumped about their new acquisition, the market's worried about the risk and headache of actually integrating a whole new company. It's a classic Wall Street showdown, company optimism versus market skepticism.
All right, so let's put it all together. What's our take on this? How should you be thinking about ASB from here? We've seen the numbers, we've heard the story, and we've definitely seen the shrub from the market. So here's our verdict.
Our rating on Associated Banc-Corp is market perform. Now, what does that mean? Well, simply put, while the company's doing a good job on its own, there are enough external headwinds and company-specific risks to probably keep the stock performing right in line with the rest of the market, not ahead of it. We just don't see a strong catalyst for it to outperform right now.
So what do we expect to see next? Honestly, we think the stock is probably going to trade sideways for a while, kind of stuck in a range. The two big things to watch are any news on their acquisition closing and, of course, what the Fed decides to do with interest rates. Now, for a more creative, outrageous but plausible trade idea. Given that ASB has been underperforming its peers, you could consider a pairs trade. That means you'd go long the entire regional bank sector, say by buying an ETF like KRE, while at the same time shorting ASB's stock. It's a way to bet that even if all regional banks do well, ASB might still lag behind because of its own unique integration risk.
And as always, we have to end with this. This is not financial advice.